Hello friends, this is Vijay Bhambwani. I've been trading these markets since 1986 and through my videos, I want to help newbie traders to understand the market nuances better. And if you want to look at some serious market clues, you're at the right place. A few points to be noted before I begin. We do not provide any kind of services, paid or free, and this YouTube channel is more for my passion about the markets rather than garnering any kind of service-oriented clientele of any sorts. Now let's begin. The strength of a chain is as good as the weakest link in the chain. So what is the weakest link in the market? What basically worries the savvy market players who invest or disinvest large sums of money at the slightest change in market triggers and fundamental and technical data, and what you should look out for. Now, let me take you back a little in time. Look at the thumbnail of these two videos. I explained to you all through last year, calendar year 2024, that 2025 is the year of pro-cyclical hysteresis in financial asset markets. And sure enough, you are witnessing signs of all this and more. Now, on my Telegram channel, the links to everything that I want you to check out, the corroborative evidence that I will share in this video is all backed up by hyperlinks to media columns of respected media houses, research reports, and everything is backed up by proof. Nothing is of kite flying emotions or goose flesh and sixth sense at all. There's no conjecturing, there is no guessing. So take a look at my free Telegram channel. That's where I put up all my research, all my thoughts, all my market trading ideas. And I told you there right from 2024 onwards that 2025 would not only be a year of pro-cyclical hysteresis, but it will start with a pincer formation. It will I beg your pardon, it will start with a phalanx formation, then it will lead to a pincer, and then what you will see is a kind of rapid decline in equity prices. That is what you saw from October 2024 all the way up to February 2025. And then I told you there would be volatility in currency prices, and then you would also have implications on sovereign debt. And this video is primarily about what the governments are doing, A, in Europe, B, in the US, and C, in Asia, specific India, and what to expect about the market with respect to these data points. So let's begin right away. Now, there are some very major changes from my point of view, of course. And if you are patient with me, I will explain to you why they should be your point of view as well. Now, there are very major changes happening in the European continent with regards to pension. Why is pension important? Because it is money that a senior citizen has when he is no longer or she is no longer able to take a job, earn money, and look after his or her living expenditure. So this is money that you receive month after month for your survival purposes. Now, there are very major changes happening to pension plans in the European Union, and it's beginning with France, which is, according to me, a surprise, because France at some point in time during its history has shown its socialist side, a caring side for its public. And when France is joining this endeavor, that tells you how serious the issue is. It's also followed by Norway, Sweden, and Netherlands is going to join the bandwagon come 2028. Now, what's going to happen in these countries where the pension plan is concerned? You see, many of the European nations at this point in time follow what is known as a defined benefit pension program. So if you are a manager drawing a salary of 10,000 euros, hypothetically, these are all examples, these are not exact figures. Hypothetically, your salary is 10,000 euros and your pension is 50% of your salary. Once you retire, irrespective of where you are, a monthly check will follow you of 5,000 euros, which is 50% of your salary. It's a hypothetical figure, right? Without you having to had contributed anything to it. It was basically a part of total cost to company, TCC, not take home pay, TCC. Now, Europe is saying, look, this pension program needs to be changed from defined benefits, wherein your pension is determined by your last salary and your last position in the company. We want to change it, a very small change, to defined contribution. Now, what does it really mean? Well, many people would say, hey Vijay, it's just a small word, from defined benefit to defined contribution. How does it matter? Now, here is where they are wrong. Now, when you go into defined contribution pension program, you contribute €1 and your employer contributes €1. If you don't contribute €1, your employer says, why should I be contributing? The law says that you have to contribute an equal amount. You don't contribute, I don't contribute, we all go home happy. That's money saved for the employer. And in any case, many of these countries, the largest employer is possibly the government, or a very significant employer, if not the largest, would be the government. So the government is cutting down its expense. Now, where is the problem? The problem is that an individual is not geared to save. In the Indian context, we are a lot more conservative as compared to Europe and America, and we tend to save first and then whatever is left after saving we spend. But there, it's possibly reverse. They save whatever is left after spending. And besides, with inflation rising up, salaries coming down, artificial intelligence rendering people jobless, the possibility of workers contributing towards their pension as much as they would have got earlier, contributing 50% of that, is a tall order. Which means when they retire, they're going to take a very small amount as a monthly check in their sunset years, which means less spending power and obviously, yes, less investing power. Now, when you switch from defined benefits to defined contribution, you are basically impoverishing the worker. And this is something that the US has already done after the Arab oil embargo. They've basically gone from defined benefits to defined contribution program over 50 years ago under the act called ERISA, Employee Retirement Income Securitization Act. What was the impact of the plan ERISA? It's a subject of another full-fledged video by itself, but ERISA was one of the many reasons why the market collapsed in 2008. Like I said, it's the subject of another video altogether. Now, let's take a look at United Kingdom, England. Now, in the autumn budget in October 2024, an inheritance tax was brought in on the rich. All right. Now, so far, you heard what was happening to a salaried worker. Here, the rich guys are getting taxed. Now, the inheritance tax was basically brought in on people who have assets exceeding 1 million British pound sterling, and they would pay 20% of that as inheritance tax from with effect from April 2026. Now, before a lot of British citizens could stop saying ouch, there are reports as per a respected publication of England called The Telegraph that reports that the inheritance tax, or what they are calling it as a death levy, may just be raised to as high as 54% in the coming budget. Now that perhaps tells you how much is the black hole in government finances that the Chancellor of the Exchequer is trying to fill by taxing the rich by way of inheritance tax, and possibly even going in for defined contribution instead of defined benefit pension program. Let's come to the United States of America as to what is happening there. Now, Sharon Epperson said on CNBC, don't forget, everything that I have told you is backed up by a hyperlink in the description below this video and in the pinned comment below this video. Please do take the time out to read those articles in detail and understand the implication for you as an investor trader in financial markets. Your family and your own future is on the line here. So Sharon Epperson said on CNBC that 71%, and that's a big number, 71% of the US consumers are in revenge saving mode. They are saving like they haven't saved before. Why? Why are 71% of US citizens saving like they've never saved before? Because they are expecting job losses, an economic crunch, an economic slowdown, and possibly even unemployment. Now, what is the data suggesting? That personal saving rate rose to 4.5% in May 2025 as per Sharon Epperson, as compared to 3.5% in December 2024. Now let's take a look at another report by NBC, carried on CNBC, and this time it was authored by Levy Steele, hyperlink below. Now, Levy Steele reports that the US consumers are basically trading down. What does trading down mean? Trading down is fairly simple. You have this product which is $5, you have this product which is $4. Both are similar in features and nature and the purpose. And you say, look, I'm not going to buy this. I'm going to buy this for $4 because I save $1 on this. That basically tells you that the consumer is tightening his purse. He's basically refusing to spend too much. He's going into survival mode in what is known as fetal position. Have you seen how a baby is in a mother's womb? Knees and elbows tucked into the abdomen, and the baby is basically in a fetal position. It is in this position that the body consumes the least amount of calories, and it is therefore in a hibernation mode. Now, this spending pattern of trading down is called fetal spending. What it basically tells you is that corporate sales are going to come down in the United States. Let's not forget tariffs. Tariffs on imports mean that prices of goods and services are going to go up in the US any which way. Trump might be able to collect money from these tariffs, but the prices, the end result will be prices on the shelves for an average American are likely to go higher, which is why he's going into a fetal position and spending less. Now, that's not exactly very great news. Has it happened in the Indian market? Yes, it has. In early 2008, markets had already started peaking and started falling after 22nd of January 2008. I was in CNBC Awaz's studio at that point in time, and I was talking to an executive who was from Parle in the waiting room of the studio for guests, and he said, Vijay, the sales of Parle glucose biscuits. Now, Parle glucose biscuits are basically a flagship brand that all Indians will remember with some amount of nostalgia. We've all consumed these biscuits at some point in time. He said the price of Parle glucose biscuits was raised marginally by $1 or $2 per packet, and the sales collapsed. So I said, well, people have to have consumed something else. He said they are consuming the same rectangular shape unbranded placebos or cheap replicas that are being made by the friendly neighborhood bakery wala, which means they look like Parle, the color is the same of Parle, the size is the same, the weight is the same, but it's a cheap ripoff. sales of those products went up. This is called trading down. What happened in 2008? It was one of the biggest falls in percentage term in the Indian stock market after the Harshad Mehta crash. There were other reasons as well. There were other markers as well. People were down trading not only just Parle glucose biscuits, but even addictive items like alcohol. Sales of more expensive whiskies and other kinds of intoxicants went down, and lower priced alcohol products sales went up. So an addictive substance is something that a person will not sacrifice. But here he was not sacrificing but buying a cheaper product. That is not a great sign. Now let me come to something that is a lot more shocking. Now President Trump is trying to garner money. We all know that because the US debt is going to the moon and back. Very soon they'll be paying 1 trillion US dollars just to service that debt. What does this very complicated jargon servicing the debt means? It means paying interest. Now, when you have to pay $1 trillion in interest, you're going to grab money from any and everywhere. Now, President Trump is eyeing the 401k kitty. Now, what is the 401k kitty? Remember, I told you about Employee Retirement Income Securitization Act, or ERISA. It created a defined contribution. Remember, defined contribution. The worker has to put in money so that the employer can also put in some amount of money. Now, this defined contribution pension program in the US is called Plan 401k. So far, there are limitations on where the proceeds or the investable sums in the Plan 401k can be invested. Trump is considering signing an executive order or a decree to allow the 401k proceeds to be invested in private investments. Does it mean the stock market? I don't know yet. But it could definitely mean private bonds, private debt, commercial paper, banks, including stocks, debentures, etc. What has history told you? It's not exactly ended very well. I hope this is an exception and I'm proven wrong, but I fear this is not exactly a great move. Now, what is the sum involved in Plan 401k? As of end of December 2024, Plan 401k held an amount of 12.4 trillion US dollars. That's not loose change. That's the kind of money that the US will be paying as interest over the next 12 years. That's the kind of money we are talking about. And God forbid, should some of it be lost, a lot of US citizens are going to feel the pinch. That is something that is worrying the market at this point in time. Let's come closer to home. Let's talk about Asia very briefly, and then I come to India. I have been telling you since 2021 that four geographical areas are something that kind of worry me. Number one, Middle East, North Africa, or MENA. The number two is APAC, Asia Pacific, some parts of it. The third one is Southeast Asia. And the fourth one is LATAM, or Latin America. There are videos that I have made in the past about this, and you can please refer to my YouTube channel on this issue. Now, China, the average Chinese citizen is drowning in debt, which he basically is finding it difficult to get rid of. Property prices are stagnant, and they will take years to basically come back to levels where the Chinese investors have bought it at. But relatively speaking, I believe China may be relatively in a better position as compared to many of the African and European nations, possibly even America over a period of time. Now, coming to India. Now, I have written on my Telegram channel extensively about what I think about what's happening, and credit growth is basically just not rising. As a matter of fact, it has fallen. Now, in spite of the fact that rate cuts have been announced by the Honorable RBI Governor in the June Monetary Policy Committee meeting or MPC meeting, and it is expected that in August as well, there is a possibility of a rate cut. Why are they cutting rates? Because they want banks to lend aggressively to borrowers so that they can do business and lift up the economy. But in spite of the fact that rates are being cut, borrowers are not lining up outside the banks. Secondly, I have been warning you since October 2021 that cost of funds will go up, which is why I recommended excellent 3 free books which you can read online by Stoken, the gold standard in cost of funds. And I hope my online family has familiarized itself with the cost of fund concept, and now therefore you should not be surprised about what I'm telling you. Now that cost of funds is going up in spite of the fact that headline coupon rates, which means the rate announced by the RBI in its monetary policy meeting or after the monetary policy meeting is over, is not the rate at which the borrower is able to borrow money at. He's only able to get it at a higher price. So there's a disconnect. So A, not too many borrowers are borrowing, and B, when they are trying to borrow, they are not getting it at rates announced by the RBI. So clearly cost of funds is going up. Secondly, and there is a link to this in the pinned comment and description below the video, Nuvama, a frontline broking firm come wealth management private client group broking firm, has reported that high frequency economic indicators of India show a slowdown to COVID-19 levels in the Indian economy. That's not exactly very great news. Now, credit growth is down to 9% in June 2025. In June 2024, it was significantly higher at 16%, which means borrowers are borrowing less. Remember, that's what I told you. In spite of falling rates, they're not borrowing money. That tells you that there's a slowdown. Now, total exports of both goods and services grew at the rate of 6% compared to double-digit growths in financial year 2023, which means our forex income is also likely to be compressed a little bit. PV, which means passenger vehicles. Passenger vehicle sales have grown at 2% this year as compared to 7% in this particular phase last year. Do refer to my free Telegram channel, wherein in August 2024, I had shared media reports about how inventory of cars have built up to 2.5 or even 3 months. And this was, August was before the Dasera come Diwali season. And I had told you that if the festive season does not witness a revival in passenger sales, all these car companies have no choice but to sell these cars at a discount so as to clear their stock. Otherwise, their working capital will get bogged down. And Nuvama further reports that profit growth of BSE 500 companies, excluding oil marketing companies, because oil marketing companies don't deal with a product that is elastic. Whether you like it or not, you will fill fuel in your vehicles at the petrol pump. So we exclude oil marketing companies from BSE 500 companies, and the BSE 500 companies have reported a profit growth of 10% compared to 21% at the same time last year. Now, where the stock market is concerned, volumes are down very sharply because of multiple factors. Number one, you have Jane Street, which contributed anything between 1/3 to 1/2 of options and futures traded volumes, depending on whether it was a routine day or an expiry day. Now, SEBI has also put into place some measures that require higher margins, especially on expiry days, higher oversight, and lower exposure allowed limits on individual traders and total exposure allowed per broker, with effect from 1st of July 2025, because of which volumes have come down. Now the bid and offer spread on a snap quote window. The snap quote window is something that you're seeing on your screen. This has hidden signals up to 2.5 dozen signals for a screen reading professional trader. Now the snap quote window has suddenly started showing you very wide bid and offer spreads. Not good news at all, at all. So the trader is basically under pressure. He's taking home smaller and smaller amounts of money. Another aspect that I want to discuss with you. I have of late, once in a while, shared with you margin funding trading by investors and traders. This is the money that you borrow from your broker. You pay 20 to 25% of the money. The remaining is funded by the broker. You can buy stocks with that money. I have noticed that margin funding has gone to near lifetime highs, even though the indices are not. Now, I have data for at least 4 dozen individual stocks and all the major traded indices, gold and silver ETFs, and a couple of other ETFs. The retail guy is putting in all that he has into the hat, into the till, in the market, including borrowed money. And positions where leveraged borrowed money trades are concerned are near all-time high. Prices are not. What happens when you're paying interest on something that you have bought and the price of that asset is rising slower than the interest cost? Think about it. It's not a very, very healthy picture. And if you have done F&O trading, you're going long and rolling over your long from 1 month to the next, you will be incurring what is known as a rollover cost. It's the cost of funding, cost of interest cost, call it what you want. But every month when you incur this cost, your purchase price goes higher and higher. Ask yourself this question. Had you gone long in the headline indices in the last 3, 4, 6, 12 months and rolled over your long positions, would you be in a profit or would you be in a loss? If you are in a profit in a particular stock, if not an index, is that profit higher than the sovereign bond yield where you can go to sleep with a comfortable pillow under your head, where the government of India is guaranteeing your money? Are you able to beat the bank FD rate? Are you sleeping comfortable? Now, this is a concept called rolling returns. Don't look at the price day to day. Give me a rolling return. You've rolled over your trade from 1 month to the next for 3, 4, 6, 8 months. Calculate your rolling return. That is a realistic return that we are talking about. I hope this video has clarified some of my views to you. I will continue to share more on my Telegram channel. Please do connect with me there. The links are in the description and the pinned comment below. Friends, I would love to have your feedback on how my videos help you become better traders. I always look forward to your comments. Do let me know what you think about our work. And please help me to reach out to a wider, serious audience by sharing my video with your family and friends, and help me spread the cult of knowledge-based investments and trades. I thank you for your patience in being with me in this video. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Take care. Bye-bye.